Every huge company out there started with just a big idea. But turning that idea into a reality, well, that takes money. So how do businesses make that high-stakes decision about funding their growth? Let's dive in and find out. Okay, so let's put you in the driver's seat for a second. Imagine you've got this amazing product, a solid plan, and you need $1 million to take it global. What do? Do you borrow the cash, or do you sell off a piece of your company to investors? This one question, it's one of the most critical decisions a leader will ever have to make.
And there's a name for the strategy behind that decision: capital structure. It's not just some finance buzzword. It's the actual game plan. It's how you mix borrowed money, that's debt, with money from owners, that's equity, to pour fuel on the fire of growth without, burning the whole thing down.
When you really boil it all down, this whole complex strategy comes down to two main roads you can take. You either borrow the money or you sell a piece of the pie. And trust me, each path has its own massive upsides and potential pitfalls. Now, to really get this, we've got to talk about a powerful idea called leverage. Think of it like a literal lever in physics, right? You use a little bit of your own effort to move something huge. In finance, it's the same thing. You're using borrowed money to try and make even bigger profits. So, this is the trade-off at the heart of it all. A company with low leverage, they're playing it safe, mostly using their own cash. It's conservative, sure, but it might mean slower growth. On the other hand, a high-leverage company is going for it, using debt to expand super fast. It's way riskier, but wow, the potential payoff can be enormous. And check this out. It's so much clearer when you see it visually. Here we have two companies, both worth $1,000. The low-leverage company on the left is mostly funded by its owners. Solid. The high-leverage one, it's way over on the right, funded mostly by debt. They have the exact same value, but they have completely different risk profiles. One is on solid ground, the other is walking a tightrope. And here's something crucial to remember. This decision doesn't happen in a vacuum. The overall economy plays a huge role. When the market's strong and loans are cheap, debt looks really, really attractive. But when things get choppy and uncertain, companies tend to lean more on equity because it's a safety net that debt just can't be. So, with all these moving parts, how in the world do managers actually make the call? Well, they don't just wing it. They use a really powerful tool to guide them. Think of it like a strategic compass for making these huge financial decisions. That tool is called the EBIT-EPS model, and its number one job, its whole reason for being, is to answer one critical question. Will this new project, funded in this particular way, actually make things better for the people who already own the company? Okay, EBIT, EPS. Sounds like a bunch of jargon, right? But let's break it down. It's actually pretty simple. EBIT is just the total profit the company makes before it pays interest and taxes. That's the whole pie. Then you have EPS, which is earnings per share. That's the size of the slice of pie that each individual owner gets. And that brings us to the golden rule of this model. At the end of the day, no owner wants their slice of the pie to get smaller. So if a funding plan causes that earnings per share to go down, it's almost always a no-go. It's a deal breaker. Now, you might be wondering if there's a perfect number. While it's different for every industry, a lot of companies seem to shoot for a debt-to-equity ratio of around 50%. That basically means for every $2 of owner's equity, they have about $1 of debt. It's a pretty common benchmark for a healthy, balanced structure. But, and this is a huge but, we have to talk about the danger of debt. It is a fixed, non-negotiable cost. See, you can decide not to pay dividends to your owners if times are tough. But the bank? You absolutely have to pay the bank. So if your sales take a nosedive, that debt payment is still due. And that's the kind of thing that can put a company's very survival on the line. All right, so theory's great, but let's see how this actually works in practice. We're going to take everything we've learned and apply the EBIT-EPS model to a real-world scenario to see how a manager would make the right call. So here's the situation for our knowledge check. A company is doing well, and it needs to expand. They need a new warehouse, and they've got two ways they could pay for it. They have to pick the one that makes the most sense for their existing owners. So let's look at the numbers the team came up with. Option 1, taking out a bank loan, results in an earnings per share of $4.50. Option 2, selling new stock, means more owners, and the resulting EPS drops to $3.50. Okay, so you've seen the numbers, you know the golden rule. Based on the model, which path is the manager most likely going to recommend? The answer is B. They're going to take the bank loan. And the why is everything, because it leads to a higher earnings per share. The manager's job, first and foremost, is to protect and grow the value for the existing owners. And in this case, the debt option does exactly that.
All right, so let's bring it all home. As we wrap up this explainer, it really all comes down to finding that delicate balance between fueling awesome new growth and protecting the value that you've already worked so hard to create.
So, what are the big things to remember? First, capital structure is your strategic game plan. Second, leverage is your accelerator. It's high risk but high reward. Third, that EBIT-EPS model is your compass. It always points you toward protecting shareholder value. And finally, the ultimate goal, the whole point, is to fund your big ideas without ever making the owner's slice of the pie any smaller. So, I'll leave you with this final thought. We've gone through the strategy, the tools, and the mindset. Now that you have the exact same framework that financial leaders use every single day, how would you fund your next big idea?